We definitely saw quite a drop in 10-year yields in the Asian session yesterday. That then reversed in the U.S. session. The 10-year yield back above 150, the 30-year yield back above 2%. With the risks out there and the back and forth that we're getting on trade, are you favouring duration on the U.S. curve at the moment?
Well, actually, we still quite like duration, especially on the U.S. curve, even at these yield levels. For some time, for instance, our 10-year U.S. Treasury yield forecast for year-end has been 125, which is admittedly quite standing out. But I think we're heading there. I think we're really seeing a convergence of global yields. I think the U.S. cannot escape what we're seeing elsewhere, especially here in Europe, if you look at especially the core markets, deeply negative.
Yeah, they're certainly deeply negative. One other market, Christoph, good morning to you, it's Manis in Dubai, is the JGB market. And this is the real challenge for a central bank, isn't it? Take a look in the GTV library. In the land of the rising sun, you're falling yields. Do you expect some kind of adjustment, movement, and pushback from the BOJ? How critical is this move to the lower bound in JGBs?
Well, JGBs have almost become a high yielder, if you like, compared to some other markets by now, and this is clearly creating problems. I think the BOJ has been very successful in their yield curve control when this was seen as a bullish impetus, but by now clearly they need to defend the yield range at the lower end, hence they may even have to intervene on the other side of the market, which tends to then, of course, strengthen the yen, which is creating some concern, also given the VAT hike and the general slowdown in the global economy. So at some point, I think they will be reluctant for a while, but at some point they may need to rethink also their rate stance, because at the front end of a curve, clearly, compared to other markets, they are only marginally negative. And of course, this would be a big impetus for the yen if they also would join the race to the more negative yields that we have seen, for instance, in a lot of European countries by now.
Christoph, we've also seen volatility really picking up. I mean, if you look at the MOVE index for treasuries, for example, we're back up near 2016 levels of volatility. How are you bracing for more volatility in your rate strategy, if at all?
Well, I think what we've seen over the summer was very peculiar in a sense that some amplifying effects have led to this very aggressive flattening of all global curves. And what is clearly behind this is the so-called negative convexity hedging. So basically ALM accounts or MBS portfolios, basically as yields fall, need to buy ultra long duration, preferably via the swaps market. And so this, I think, has been an important amplifier for this flattening. And there are some parallels actually to December 2008, especially in Europe, where it was the Dutch pension funds actually that caused a very aggressive flattening out to 50 years, turning or inverting the curve there massively within a few weeks. And then also within a few weeks, actually, we reversed most of that. So I think there is a decent chance that as markets calm down, as also liquidity returns after the summer, that we could see a at least re-steepening impact in the ultra-long part of the curve as some of these hedging programs have been completed and people look at these valuations. For instance, take 50-year euro swaps at zero. This hardly can be justified by fundamentals, no matter how gloomy your view is on the world.